You're in the Business Insurance Zone with me, Steve Savant, national insurance columnist and financial color commentator. This week on The Biz, the Life Insurance Income Series, our tribute to Life Insurance Awareness Month. And on today's show, the internal rate of return on life insurance income plans.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone. I'm your host, Steve Savant. We're broadcasting live to a nationwide audience of financial professionals right here in Fountain Hills, Arizona, home of America's largest fountain. And again, this week and today, not only today, but all this week, Eric Palmer will be co-hosting with me. Welcome to the show, Eric.
Glad to be here.
We're talking about our wheelhouse marketing effort in tax-free income using life insurance. And what I really like about this show is you need to really unpack some things. And last week, we gave you the introduction. But this week, we're talking a little bit more depth. We're trying to really cover all our caveats, make a little more disclaimers. We ought to always make sure that we're talking about everything we need to talk about. Now today, one of the great measurements is internal rate of return and expense reports. Now, Eric, I got to tell you, we're one of the few that I'm aware of that actually print the expense report for everything that we do and include IRRs, not only on death benefit, which everybody kind of does that, but we do cash value, internal rate of return. I want to know what my internal return is, and the financial community, just one little small stop before I let Eric go. The financial community is actually based on internal rate of return. We don't do insurance cost indexes. Nobody looks at that anymore. And so I don't know why we keep printing it out, because really it's irrelevant, especially for income.
Sure. Well, internal rate of return is really more important in a lot of cases that we come across for those fiduciaries that are either CPA or they're FINRA registered. They tend to look at that stuff a little bit more, and I think it's something as insurance advisors you really truly need to start to adopt, because at the end of the day, especially when you're working on some of the larger cases or business-oriented cases, if you can talk to that client's a CPA or accountant and show them internal rate of return, you're going to be talking their language, and you're going to have a lot more buy-in from the fiduciary of the client, not just the client themselves. So understanding these products from front to back and being able to talk about all the components, including that internal rate of return, I think is extremely important to be successful in this business.
And remember, all of our universal life chassis, whether it's current assumption, index, or variable, and of course guaranteed, but we're not using it for this purpose, they all have breakouts on expense loads. So you can see all this. Now, before I get in too much trouble here, I just want to make one small complaint after 30 years. That complaint is that I cannot break apart, unbundle, or unpackage whole life. I just can't. I have a policy fee and I have the base premium, and I don't know what's going on inside that base premium. So I can't really unbundle it. I can't unpack it. It is what it is. And it's always been what we call the mystical box. We don't know what's inside it. So I really don't have a reason to measure that. Now we're showing some par whole life product for our retirement, because there's people that like that idea, because they like that long-term tied to the treasury idea. They kind of think that's a good thing. But I'm just telling you, it's hard to unpack it. I can do the internal rate of return, but I don't know what it's coming off on.
Well, at the end of the day, you run the numbers, and I think we can understand that inherently in these contracts are a little bit more expensive than some of the alternatives that we show, universal life chassis type contracts. But if your client really is a conservative individual looking for the guarantees, par whole life is still a winner, and it's still a product you should understand, because you're taking out some of those indexing risk components. You're taking out some issues that you may not like about an index universal life insurance contract if you're looking at some of the supplemental income type scenarios. So whole life still plays a role. There is more moving parts, and we can't unwrap them completely, but they still will perform, especially if you're talking about tax-free loans or earning interest on the money that you could loan to yourself.
Well, when you think about it, we're trying to look at these products as a tax-advantaged way to play for our retirement income. And remember, one of the big things that I've noticed is a lot of people have discretionary monthly income. Not so much dump money or lump sum money, but a regular dollar cost averaging. And one of our show giveaways today is our little two-sheeter on dollar cost averaging. If you've never seen this, just order it at thebiz at brokersalliance.com, and I'll send it to you absolutely free. I think that's a great opening salvo. It shows clients how to mechanically invest or save on a monthly basis, and it's really great.
Well, when you want to tie in life insurance too, one of the things that most of our viewers have probably seen already is we're advertising a sales program, or a solution, if you will, that ties in some calculators and a presentation with a video to sell index universal life insurance. And one of the things that we're going after, or that we're starting to focus on, is the 401k market specifically. And if you think about it in a way, in the 401k market, if you're contributing on a monthly basis, in a sense, you're dollar cost averaging. And so when we're going in there showing the alternative being an index universal life insurance or maybe a par whole life contract, you know, we need to understand what dollar cost averaging is, because we're showing our clients putting monthly premiums in and contributing to these things on a regular basis, maybe not just a one lump sum on an annual basis. So dollar cost averaging comes into play, and it spreads out that risk, if you will, in terms of exposing large sums of money versus smaller chunks over time to the volatility of the market.
And we have some really good information on this, and we think our customers really appreciate the actual introduction to the idea of dollar cost averaging. So again, just order it at thebiz at brokersalliance.com and we'll send it to you. I want to look at a tale of two cities today on expense loads. Current assumption UL uses an interest rate, and we can break out all the expenses, but right now, because the rate is so low, it's not getting the play. It's getting, and we'll see a little bit more of this. If we start getting interest rate tick-ups, that'll be reflected, but right now it's still kind of low. So I'm really looking at the two areas, index universal life and variable. Now, one heads up on VUL. It's kind of making a small comeback only because we have a lot of clients that are into non-qualified mutual fund purchasing at the dollar cost averaging using a monthly fee. Now, I like that. And if I'm going to use VUL and I suppress the death benefit according to the TAMRA regs, I can maybe get, if I'm a long haul guy, I can get some numbers out of that.
Sure.
So when I'm thinking about variable universal life, I have to look at all the expense loads. And when we come back, I'm going to give you the yin and the yang on that, because most carriers, with their own internal kind of civil war of expense loads, you're going to be so surprised, as I am always surprised, at the games that are being played on the expense sheet. But that's the best part about UL, it's fully disclosed. When we come back from the break, we're going to address the internal costs of life insurance retirement plans. And don't forget to enroll at our IULuniversity.com for the best training, education, and sales support when it comes to life insurance for retirement income.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Everyone's looking forward to retirement, but how do you get there from here? You do it by paying yourself first every month and saving with Index Universal Life. And once you're there, how long is your retirement? With Index Universal Life, it can last a lifetime. How much can you keep? It lets you keep all of it. And what if you need it sooner than later? There's no penalty for early withdrawals, and you have the flexibility that you need. How to get started? Go out to www.iflplan.com and find out more and start looking forward for retirement. Well, welcome back to the Business Insurance Zone. I'm Steve Savant with Eric Palmer. And remember, you can order today's giveaway at the Business Insurance Zone, the biz at brokersalliance.com. And just a heads up, before moving forward with any of the ideas you hear on the show, always consult your tax advisor and broker-dealer compliance officer. We're talking about the internal rate of return and the internal cost of life insurance retirement plans. Eric, when I left, we're talking about VUL versus indexed.
Right.
So I've noticed I'm using a carrier here, same carrier, and I'm not using arbitrage or participating loans because I want to really show the expenses as naked as it gets.
Right.
Okay? I've noticed that you're losing a significant amount of internal rate of return because the cost of insurance is higher on VUL.
Right.
And I have additional M&E charges that I don't have in indexing.
Right.
Now talk a little bit about that, because I think people really don't understand that. Again, if you're doing non-qualified mutual funds, I'm all over VUL.
Right.
Because if you already understand the risk and things of that nature. But when we're talking expense loads for retirement, I want to look at the yin and the yang of this, and I haven't even brought up the issue of principal preservation.
Well, and I think more importantly, you have to look at the acceleration of the variance. So, for example, the first couple of years of VUL contracts really close. And in fact, I think with the comparison we made today, even in year one, the internal rate of return is a little bit higher with the VUL than it is the index. But as you start to go down the chain, you get to the 10 to the 15 year mark. And when we're talking about supplemental retirement income, that's really kind of our landing zone. The VUL gap starts to really take off, and you start to see those M&E charges compounding over and over again. So I think the biggest component that you don't see in IUL that you see in VUL are those M&E charges, and you get about a 50 basis point to a whole 1% change when you get somewhere down the road. I think it was about 25 years.
One of the things that we never bring up is, remember, a lot of these M&E charges, you know, it's as the asset gets bigger, you know, the charges per the asset, right?
Right.
Whereas it's kind of flat with indexing. So when, as you said, during the accumulation, by the time I get 20 years out, I'm going to have about a 55 to 65 spread by the way we do it, and that'll be an advantage to the index, that actual return on money, because we don't have M&E and our COIs aren't as high.
Well, and to be fair too, we're using a comparison with the contract that's known as being one of the more affordable, having one of the smallest structures for cost of insurance, plus all the additional charges. So I think we're being more than fair by giving the comparison on one of our better companies for those charges. The reality is, if we ran this comparison for all the VUL, it'd probably be a little bit higher of a variance. It'd probably be right around 1%.
Now, when you think about this, one of the reasons why we do these comparisons is I'm taking this company that does not use arbitrage loans and have zero net cost loans guaranteed in their contract day one. What this does is it strips down the cost for me to show, is the index a better chassis or is the VUL a better chassis? And if we're just talking expense loads, I mean, who can predict the equity market? Who can predict the index market?
Right.
I can't. But I can kind of understand expenses.
Well, and I think, one of the arguments you'll hear a lot of times is that, some of the charges may be higher in the variable product, but the variable also has the opportunity to have a little bit better growth and an average rate of return. So, you have to, like you say, yin and the yang, you have to weigh both options. And I think that's why we're on our show talking about both options, is making sure that everybody knows, we're not partial to one over the other. What we're really trying to do is expose the fact that we do this analysis every single time we look at a case, and we will help you understand who does have the better internal rate of return and why one may be better than the other. If your client's more open to some risk, we might put a VUL on the table, give them the opportunity to have the additional growth, and as you mentioned, manage it a little bit closer. It's like the 401k market right now. There's people that are successful with their 401ks because they've almost become money managers themselves, and they're daily looking at their funds and what funds that they're in and changing things around. You can treat a VUL very much the same way and manage that risk a little bit closer. And if you're getting a stronger opportunity for return, it might be worth the extra 65 basis points too. Yeah,
and you have to measure that out. But remember now, with caps being as high as they are on IUL, and they are up there. I mean, our leading is 17%, I think, isn't it?
Right.
17%. Now, VUL does participate in dividends. We're going to get into a lot of this at the end of the week. We're going to talk about this, but that's what I'm saying. If the caps were really low, I don't know if I'd have an argument.
Right.
But since the caps are all double digit, and most VULs can't even show 12%, over 12% anyways.
Right.
I don't know why I'm really sweating the bullets, but I just want to show the mechanics. And by the way, this is one of the big tip-offs for us. When I see a side-by-side comparison, and I notice even in index, wow, why is that internal rate of return low when I'm showing 8% as a gross number? I can always tell, they're not mitigating the death benefit issues, or they're not using the right option.
Right.
So the internal rate of return is the first thing I look at so that I can say, I better look at that expense sheet, see what's going on. I better look at the death benefit. I better look at the option. And one of the things we do here is really look at all these issues, because our job is to mitigate expense loads all the way down to the ground, and cost of insurance is pretty much the only place to play, and we do that.
Well, I think it's important to note too, we spreadsheet things, but we don't live off of our spreadsheets. We might find that after putting all the material onto our data sheets, we find that there's the top 3 or 4 companies that we should be analyzing, and then we really take it a step further and we break it down. We start looking at things like the internal rate of return, which you don't find on your typical spreadsheets.
Right.
You got to run the illustrations for this stuff. Right. And so if you're not even FINRA licensed, or you're not open or available to running the variable illustrations, we can do them internally and at least give you the knowledge that possibly your index or your whole life contract is competing very well against some of those types of alternatives. So the analysis that we do behind the scenes is beyond the spreadsheets. I think it has a lot to do with experience and kind of knowing additionally what we can look at to win the case for our client.
If you want an example of an IUL and a VUL, and the one we're using now, that's one of our show giveaways. So just write me, thebiz@brokersalliance.com. Say, Steve, send me these illustrations that include the internal rate of return and the hard IRRs. I mean, I think that's fair.
I think that's great.
So when you're thinking about this, I want you to start saying, what are some of the mechanics? Steve, I don't understand this much. That's why I like to spell it out. It's easy to understand. The expense loads are always in the back of the pages. The IRRs really show the truth from the error. That's what you want to look at. That's what you need. Remember, you can watch this show and all our shows by clicking on the red on-demand video button right on our homepage at brokersalliance.com. Well, that's the Buzz on the Biz for today. You've been in the zone, the business insurance zone.
The Biz is brought to you by Brokers Alliance, a national leader in insurance products, support services, and educational workshops. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.